If you're collecting Social Security and watching up to 85% of your benefits get taxed away, you're probably furious. But here's what most people don't know: there are completely legal strategies to reduce or even eliminate the taxes you pay on your Social Security benefits. I'm going to tell you 5 simple strategies that can save you thousands of dollars every single year. And strategy number 3 is something almost nobody talks about, but it's incredibly powerful. Before we dive in, I need to say this: I'm not a tax professional or financial advisor. This is educational information based on current tax law, but tax situations are personal and complex. You should absolutely consult with a CPA or tax advisor before making any decisions. These strategies work for many people, but your specific situation might be different. Also, tax laws can change, so make sure you're working with current information. Okay, now let's get into the strategies. First, let me quickly explain how Social Security taxation works, because a lot of people don't understand this. Your Social Security benefits may be taxable depending on your combined income, which the IRS calls your provisional income. This is calculated by taking your adjusted gross income, adding any tax free interest, and then adding half of your Social Security benefits. If that number is below $25,000 for single filers or $32,000 for married couples filing jointly, your Social Security is not taxed at all. Between 25 and 34,000 for singles, or 32 and 44,000 for couples, up to 50% of your benefits may be taxable. Above 34,000 for singles or 44,000 for couples, up to 85% can be taxed. So the goal with these strategies is to keep your provisional income as low as possible. Strategy number 1: use Roth conversions strategically before you start collecting Social Security. This is huge. If you have traditional IRAs or 401ks, those withdrawals count as taxable income and increase your provisional income, which means more of your Social Security gets taxed. But if you convert some of that money to a Roth IRA in the years before you claim Social Security, you pay taxes on the conversion now, but then all future withdrawals from that Roth are tax-free and they don't count toward your provisional income. Let me give you an example. Let's say you retire at 62, but you're not claiming Social Security until 67. Those 5 years are a perfect window to do Roth conversions. You're probably in a lower tax bracket because you're not working and you haven't started Social Security yet. You convert maybe 30 or 40,000 a year from your traditional IRA to a Roth. You pay the taxes on those conversions now while you're in a lower bracket, and then when you're 70 and pulling money from that Roth, it's completely tax-free and doesn't increase your Social Security taxation. Strategy number 2: invest in municipal bonds or use a high yield savings account strategically. Here's something important: interest from municipal bonds is generally tax free at the federal level and sometimes at the state level too. And more importantly, it doesn't count toward your provisional income calculation for Social Security taxation. So if you need income from your investments, municipal bonds can provide that income without triggering taxes on your Social Security. Now, interest from regular savings accounts and CDs does count as income, but if you're below the threshold anyway, this can be a safe place to keep money and generate a little income without pushing you over into taxation territory. The key is understanding what types of income count toward that provisional income number and structuring your investments accordingly. Strategy number 3, and this is the one people don't talk about: delay claiming Social Security as long as possible while living off other income sources. I know this sounds counterintuitive, but hear me out. Every year you delay claiming Social Security past your full retirement age, your benefit increases by 8% up until age 70. That's a guaranteed return you can't get anywhere else. But here's the tax advantage: if you can live off savings, Roth IRA withdrawals, or other non taxable income sources in your 60s, you can let your Social Security benefit grow while keeping your taxable income very low. Then, when you do claim at 70, your benefit is significantly higher, but you can structure your other income to keep your provisional income low enough that less of it is taxed. Plus, you had all those years of low taxable income in your 60s. This requires planning and having enough other assets to live on, but if you can make it work, the math is incredibly favorable. Strategy number 4. Consider relocating to a state with no income tax. This doesn't help with federal taxes on Social Security, but 13 states also tax Social Security benefits at the state level. Those states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Some have exemptions based on income or age, but if you're living in one of these states and paying state tax on your Social Security, it might be worth considering a move to one of the 37 states that don't tax Social Security at all. States like Florida, Texas, Nevada, Washington, and others have no state income tax whatsoever. If you're flexible about where you live in retirement, this can save you thousands of dollars every year. And yes, I know moving is a big decision with lots of factors, but from a pure tax perspective, it's worth considering. Strategy number 5, be strategic about when you realize capital gains. If you have investments in taxable accounts, the timing of when you sell those investments and realize capital gains matters. Capital gains count as income and increase your provisional income, which can cause more of your Social Security to be taxed. So if you need to sell investments, try to do it in years when your other income is lower, or spread out the sales over multiple years instead of doing it all at once. For example, if you need $50,000 from your investments, instead of selling it all in 1 year and spiking your income, consider selling $25,000 this year and $25,000 next year. This keeps your provisional income lower each year and potentially keeps more of your Social Security tax-free. Also remember that long-term capital gains have preferential tax rates, and if your total income is low enough, you might pay 0% on those gains. Here's a bonus tip that ties everything together. Work with a tax professional to run projections. A good CPA or enrolled agent can model out different scenarios for you. They can tell you exactly how much you can withdraw from different accounts, when you should claim Social Security, and how to structure everything to minimize your total tax bill over your lifetime. This is complex stuff, and the right strategy for you depends on your specific numbers, your other income sources, your health, your life expectancy, and your goals. Spending a few $100s on professional advice can save you tens of thousands in taxes over the course of your retirement. Don't try to wing this on your own. Let me quickly tell you the biggest mistakes people make. Mistake number 1, claiming Social Security as early as possible without considering the tax implications. Yes, you can claim at 62, but your benefit is reduced and you might be pushing yourself into a higher tax situation for the rest of your life. Mistake number 2, taking big withdrawals from traditional IRAs while also collecting Social Security without realizing how much it's going to increase your taxes. And mistake number 3, not planning ahead. All of these strategies work best when you implement them before or right when you retire, not 5 years into retirement when you're already locked into certain decisions. The bottom line is this: Social Security taxation is based on formulas and thresholds, and when you understand how those work, you can make strategic decisions to keep more of your money. You worked your entire life and paid into Social Security. You shouldn't have to give a huge chunk of it back in taxes if you don't have to. These 5 strategies, especially when used together, can dramatically reduce or even eliminate the taxes you pay on your benefits. It takes planning, it takes discipline, and it takes professional guidance, but it's absolutely worth it. The difference could be thousands of dollars every single year for the rest of your retirement. Which of these strategies do you think will help you the most? Tell me in the comments. And if you found this valuable, please hit that like button and subscribe to this channel, because I share retirement planning and tax strategies that can save you serious money. Don't forget to consult with a tax professional before implementing any of these strategies. Thanks for watching, and I'll see you in the next one.